Hello, this is Nathan Wilson with GuideSpring Wealth Strategies. We are going to be discussing today the habits of the wealthy. I am the CEO of GuideSpring Wealth Strategies and the Chief Financial Advisor. My accreditations are Certified Tax Specialist and Certified Estate and Trust Specialist. The habits of the wealthy. We're going to cover 4 bullet points today. First one is know what you make and never underestimate the power of theft. Taxes. Number 2, have assets to pay for liabilities. Number 3, pay yourself first. And our final point, what to ask for of your employer or what to offer your employees. First point, good habits are practiced. A habit by definition is repetition. They say it takes 28 days to make or break a habit. So by default, this is something you have to practice regularly. So we're going to dive into that, protect yourself from theft. The IRS is the enforcement arm of the United States Treasury who collects what Congress tells them to collect. The problem I have with this system is Congress, if they don't know how to run a budget, can just vote themselves a pay raise in the way of a different tax code or increased taxes. And once that gets to the IRS to collect and enforce, we really don't have a choice in the matter. Now, I have been told, the statement taxes are theft is maybe a little inaccurate, that we get goods and services for that. And that is true. I mean, it's not just disappearing. We have roads and jets that protect us. The point I'm trying to make is I haven't had anybody raise their hand when I ask them the question, how many people in the room made a voluntary donation to the IRS last year? Despite your views on taxes, I've never had anybody raise their hand that they make a voluntary donation to the IRS. We pay what they tell us to pay. And we have to pay what they tell us to pay. And so that's why I use the vernacular there. Taxes in retirement. Some years back, I kind of did an inquiry to try to figure out where was the source of the adage that taxes are less in retirement. The closest I got was people that claim they could live on less in retirement. And my reply to that is if your retirement plan is to retire with less money than you are working, then that's not a good retirement plan. And the second thing is, my expenses are less because, my house is paid off and my kids are graduated. But when we talk about taxes, if your house is paid off, you lose the deductibility of that interest. And if your kids are gone, you lose those exemptions. Now, we're in a new tax law where maybe you can't write off your interest or you're limited to $10,000. And we lost our exemptions on the kids, but this is a perfect example of how taxes are not guaranteed to be less in retirement. Oftentimes we find that they are higher in retirement, if not the same. So you need a plan for them. The problem with the 401k and the IRA is if you're watching the video recording of this, you can see our graphic. You're looking at your balance. I often hear clients say, I have $500,000 in my IRA. And I want to say, no, you don't. You have $400,000 in your IRA, and you have $100,000 that is an unpaid loan to the IRS if you're in the 20% bracket. The problem is we're growing these assets. So if you put, let's say, $10,000 into an IRA and you receive a tax deduction for the 20% bracket, that's a $2,000 tax deduction. However, if that money doubles at, let's see, every 10 years, then that becomes 20. The next 10 years becomes 40, and then it goes to 80. And then if you pulled that same 80 out, 3 decades later, and paid 20% tax on it, it's a lot higher, 4 times higher, than the tax deduction you got going in. And that's the problem is we invest our IRAs and 401ks to be successful and to get a rate of return. You're growing your share and you're growing the IRS's share. Of course, the problem with this is the IRS doesn't necessarily have an agreement with us that the money we pay in taxes coming out will match the deduction we received going in. In fact, a lot of younger people under 35 years old, they may be getting a deduction on 10% federal bracket or 15% federal bracket. And when they retire, they could be in the 30 or 35% bracket. So I really believe the IRA and the 401k are tax codes written by the IRS for the benefit of the IRS, and they control all the strings. So I would say if you're under 35 years old, you should not be deferring taxes using a 401k and IRA, with the exception of free money. If your employer is matching 3%, then you contribute 3% to get that match, but don't contribute any more than the match your employer gives you. If you can save more than that, save in a tax code that you could take the money out tax-free. That's the difference between tax deferred and tax free. Is tax free, you don't get the tax deduction going in, but you also don't pay the taxes coming out. And that makes a big difference on being able to control things. When referencing your paycheck, how many different types of taxes do you pay? I encourage you to get a copy of your pay stub and look at it. In this day and age, most of us don't get that. It's digital. You have to log into HR or the payroll company to get a copy, but get a copy. If you notice on the first part, it has your earnings, your rate, and your number of hours. You should pay attention that that's correct. There are mistakes in payroll. People do get raises and it doesn't get translated always right to their paycheck. Pay attention to the overtime line if that is correct. Also pay attention to your vacation time. If you have it, use it, especially if it's a use it or lose it position. As an employer, I regularly encourage people to take vacations. I tend to find that it improves their creativity when they return if they step out and take a break. But once we get to that gross pay, then all the fun starts. And by fun, I mean taxes, which is not fun. So you look at the number 2 of our example here, you've got federal taxes coming out. But then you also have Social Security tax, a Medicare tax, and a state tax in some states. This is what I like to phrase as taking bites of the apple. And, my common question is, how many bites of the apple can we take before there's nothing but a core left? We started in 1913 with a federal income tax. Before that, we didn't have one. And now we've got a state income tax and a Social Security tax and Medicare tax, and they seem to be taxing the same dollar more and more. But this is where I encourage people to kind of think about these ratios. A lot of times you file your taxes and your accountant says you're in the 20% bracket. And then I ask you, hey, what bracket are you in? And you say, I'm in the 20% bracket. But when you're saying that, you're referring to federal. But if you're in the 20% bracket on federal and you add the 7.65 of Social Security and Medicare, and then you add the state tax of 4 or 5%, you very clearly could be in the 35% bracket. And so you've got to really pay attention to that. And that is why on this third line here on your earnings statement, this is why it is so tempting to put money into the 401k, because it reduces our taxable income and we get a little benefit of immediate gratification from that now, but it creates all kinds of problems later when all of your assets have an unpaid lien to the IRS in retirement. You'll notice there's some other codes there, non-taxable expenses, sometimes reimbursements from your employer. If they offer those, definitely file the proper paperwork and get them. And then health benefits like flex savings accounts or HSAs that allow you to save money pre-tax to use for healthcare expenses later on in the year. So raise your hand if you think you should be saving if you have debt. And how many of you think you shouldn't be saving if you have debt? This is a common thing that we get from a lot of, especially younger clients coming out of college and having student loans, or maybe you kind of were frivolous and you acquired some credit card debts and you're trying to get a hold of those. Maybe you have just a home loan and you're fixated on paying that house off early. And this is where I walk through the exercise of apples versus weeds. One of the good habits of the wealthy that is practiced is they pay for liabilities with assets. When I see wealthy clients, they don't necessarily not have any debt or any loans or liabilities. It's just they have more assets than they do liabilities. And this is what a balance sheet is. A balance sheet is assets minus liabilities equals net worth. And so it's kind of the phrase of if your right hand owes $100 and your left hand has $100, then do you really have debt? Because, you have a positive $100 that offsets a negative $100. And so the reason I bring this up is because there's a choice between strictly focusing on paying liabilities or paying down liabilities in an educated and mathematical formula, but simultaneously saving for assets. The example I give is what happens if you had a primary house that had a mortgage on it. Option A is to focus exclusively on trying to pay off that mortgage and all your discretionary income goes towards that. But what if, another person in a similar scenario with their extra money bought a rental property and that rental property's rent helped pay down their mortgage, but the asset was also appreciating. Both of those are acceptable strategies with very different results. The apples versus weeds example is if you have 100 acres that is to be your future farmland and it's all full of weeds, you could spend a lot of time just pulling weeds for 100 acres. And then you look back behind you and there's nothing but raw dirt. But the problem is apple trees, which bear the fruit, in this example, retirement income and retirement, take years to mature. An apple tree takes 8 years before it starts to produce fruit. So I think it makes a lot more sense that as you pull an acre of weeds, you plant an acre of apple trees before moving on and addressing the rest of the situation. And so I really encourage you to take a look at, making sure you've got assets and you've got liquid assets, because if you lost your job or became disabled and you'd spent the first 15 years of your career paying off your house and you lost your job, a bank's not going to give you a loan on the equity on your home. And if you had assets that could protect you in that situation, it would be better to have them outside of your house, So when we get into the definition of assets versus liabilities, assets put money in your pocket. That's the definition. Liabilities take money out of your pocket. So in the live presentation, we asked this in a group format, in a dialogue, is your IRA or 401k an asset or a liability, or both? A lot of people said both, and that's because they were listening early on. You have an unpaid loan to the IRS, that's a liability inside of your IRA or 401k, and then you've got the money left over that's yours after you pay off the IRS, and that'd be the asset section. But I would say they're an asset because they're not taking money out of your pocket. The taxes are deferred, so there's an element of a liability there. The next question is a house. Is your house an asset or a liability? This is one that I very clearly say is a liability. Your house is squarely a liability by this definition. Liabilities take money out of your pocket. You're making house payments. That's a liability. Even if your house is paid off, you have property taxes and you keep your homeowner's insurance. That's a liability. I don't know about your house, but my house needs constant updating and repairs, and that's a liability. So that's, I think, some of the trouble I see with the young professionals coming out of college is they seem to be sold this idea, maybe from their parents, that the great American dream is to go buy a house. Well, that's just buying another outgoing cash flow item. And maybe that's for you at this point in your life, or maybe it's not, but you shouldn't buy it because you feel like it's going to make you get ahead of life from a financial balance sheet standpoint. So raise your hand if you buy beverages each month. I got some pictures of some Starbucks here and some tall beers or whatever. And so the example here is sometimes people say, well, I don't have enough money to save for retirement, but yet they consume discretionary items such as eating out or buying coffee or beverages. And guess what? In retirement, you're going to want to consume those too. And so you really need to allocate your resources towards saving for your future. Raise your hand if you want to retire wealthy, right? I mean, I'd like to see that that's the overall game plan for the majority of us, right? But our third point here is good habits are practiced. You have to pay yourself first. If you are trying to save money at the end of the month, you won't have any money to save because money is fluid. It does ebb and flow. And of course, it leaks out of the bucket too, as well, And so you kind of lose a little bit of control on your money once it's in your checking account. A lot of people try to budget from the bottom up, which means they assign, how much they're going to rent, how much they're going to the liabilities, and how much they're going to, eating out and food. And they try to get everything in neat little categories. And if you're disciplined enough to do that, that's great. You're going to be way ahead in your retirement years. But for a lot of people, they're not that disciplined at doing that. And the easier, more fail-safe way is to save off the top and to pay yourself first. We're kind of conditioned that when we get our paycheck net of taxes, that the first bill we pay is our rent or our house payment, and then our car payment, and then, your student loans payment, and then, your utility bills, and then your cellular bills. And we feel like we've got to always pay our bills first. And that is good financial discipline, but you really have to pay yourself first. You have to take money right off of the top. Because Parkinson's law, which is an economist, Parkinson's law says expenditures rise to the level of income. Think about it. When was the last time you got a raise? You're probably living about the same lifestyle you were living now back before you got your raise. And you probably couldn't save anything then, and then after the raise, you're not saving anything now. Why? Because expenditures rise to the level of income. The only way to defeat this is to save first. So literally call your payroll company, or if you're self-employed, you should still have a payroll company, and have them direct deposit 10% of your net pay to your savings account. And when that gets upsized, have them deposit it to your investment account and start to invest some of this money, and just learn to save 10% before you even get your net paycheck. You'll be surprised how affordable it is, because it leaks once it gets in your checking account. It leaks out until it's gone. The example I give is you got 2 coffees and 2 beers a week, so $5 each, and there's 2 of them a piece there. For 25 years, that's $26,000. If that $26,000 was invested, that's a $70,000 number at the end of 25 years. And this is talking 2 coffees and 2 beers a week. That's a very small start. So good habits are practiced. People that have money in retirement that you'd consider wealthy saved when they weren't wealthy. That's how they got to be wealthy. They saved when they couldn't afford it, and they saved when they were young, and they saved when they had debt still. How to pay yourself first. You could create a budget and decide money where it goes before it goes. And I recommend this. It's easy to track. The trick here is to look at math objectively, not emotionally. This is a judgment-free zone. Whatever you did in the past, or whatever bad habits you did, is going to feel like going through dirty laundry when you try to start your budgeting system. It is important to be in the judgment-free zone here, and just to write it down, just to track it. That is the only goal at this part. If you're married, this is not the time to get into a marital dispute on who spent money inappropriately, because naturally you're 2 different people. You're not going to have the same money habits. One's a spender, one's a saver, and that's fine. We're just tracking it at this point. And then know where it goes before it goes, and then make some little adjustments. If you can curtail your eating out budget from $350 a month to $300 or $250, then look how much money that could compound. And sometimes it's just making smart decisions. If you eat out, maybe it's cutting off the sodas and the alcoholic beverages. Those are high margin items for the restaurant. The appetizers and desserts are high margin items for the restaurants. So maybe you go out to eat the same amount you do now, but you just don't order those items. But definitely put a percentage of your paycheck into savings directly from the payroll company, and start with something. I recommend 10%. The books on getting wealthy talk about that 10% rule, saving 10% of what you make, always through every stage in life. But if you can't get to 10 right away, start with 2. Next month, go to 3. Next month, go to 4. You'll be surprised how easy it feels once you get going. So raise your hand if your employer offers benefits. How many of you know your benefits? So the 4th habit is habits of the wealthy. Know what to ask for. If you're an employer, know what to offer. A lot of times there's so much conversation about the 401k being the benefit to offer or to participate in from an employer-employee standpoint. And we've already talked about the problems with that from a tax side. The fees and expenses on those plans are very high as well. But we don't hear a lot of conversation about a real major risk, which is disability. In Colorado, roughly 22% of people report having a disability. And if you have money in the 401k with a disability, it could be a problem. There could be a penalty tax, but there's always going to be a tax getting it back out. And it affects your retirement. And an easy way to hedge this is just to participate in the disability benefits that your employer offers. Short-term disability, which covers almost immediately to 30 days out as an elimination period, the short term of your disability is the most expensive benefit to buy because most disabilities are short. And you don't have to have short-term disability if you have an appropriate sized savings account with 3 months worth of living expenses in it. So that's the money you can save. But long-term disability is very cheap, and you really should offer it to your employees. And if you're an employee, you really should have it. If you can't get it through work, obtain it privately. The advantage of getting it through work is it's easier, there's no underwriting, and it's cheaper. The disadvantage is it goes when your job goes. And if your health changes, you may not be able to get it again. It may be more expensive, or you may be uninsurable. And so an advantage of having private disability is it goes with you as your job changes. When you have your next review with your employees or with your employer, look at the benefits and know what to ask for. We talked about the problems with the 401k and the deferment of taxes and how Congress raises taxes as they go. But I didn't make the distinction that there's another kind of 401k called a Roth. A Roth is you don't receive the tax deduction now. In exchange, the money grows and compounds tax-free, and you could take the money out in retirement tax-free. So if you have a 401k Roth, I would encourage you to participate in that because it's not taking the immediate gratification of a tax deduction now, and you're going to be thankful for it when you don't have to pay taxes on it in retirement. But also see if you could just direct deposit into a Roth IRA itself from the payroll level. The other really cool thing is I like these little flex spending accounts and health savings accounts because the tax code doesn't necessarily always let us write off things like our prescriptions and our insurance. Sometimes insurance covers wellness exams and physicals. Sometimes it doesn't. Sometimes it doesn't cover dental or alternative medicines like acupuncture or chiropractic. And so you have to pay for those money out of pocket with after-tax dollars. The flex spending account allows you to save, $1,000 or $2,000 in a given year pre-tax. That you have a little debit card associated with that, and you can spend it on qualified medical expenses like prescriptions and doctor visits and such. It is a use it or lose it in the flex spending account. So if you put $1,000 in and you don't use it, it goes away. But that's easy to mitigate. You know how much your yearly physicals cost. You know how much your dental cost, and you can estimate your copays and prescriptions. And you just use the benefits. You just fund what you're going to use. But this is a great thing to offer employees if you can, and definitely participate in it. And it's a tax saving strategy as well. So that is 4 habits. The concluding points here are the other good habits is educate, advocate, and get a team. Those that know what they have fare better than those that don't. The ostrich syndrome doesn't work. Sticking your head in the sand and saying it just doesn't exist is a fallacy. So know what you have. Know what you're working with. And find a team. A team helps keep you accountable. I recommend an independent financial advisor. What I mean by the word independent is they work for you, not the house. If they're paid by their employer, the bank or the brokerage firm, and they're not paid directly from you, then you've got to see if there's a conflict of interest there. And an independent financial advisor kind of gives you that factor. The other thing is they should really focus on other things besides investments. You know, we talked about disability insurance or life insurance. We talked about the health savings accounts. We talked about tax codes. You know, they should be able to work on that as well as help you with budgeting. A tax consultant, you know, I think you should get a CPA that talks to you a lot about what this upcoming tax year is going to have for you, not necessarily one that just files last year's tax return. And a legal consultant. I am a big advocate of, as being a parent myself, of having your will in place. A will governs who is the guardian of your kids in the event of your death, and you need to have that established and provide for their care through making sure they're taken care of. I really think not having a will when you have kids is kind of what I would categorize as irresponsible. So that is an easy thing to fix. We can give you some direction on that if you would like. A couple of freebies I always like to give is the books I like to read and give away. The Richest Man in Babylon by George Clason. Old book, classic. It's a very small book. You can read it in an hour, hour and a half. It's written almost in a parable story-based form. And if you have kids, please give it to your kids. Let them read it. It will start them off on good money habits from the beginning. And largely, it talks about paying yourself first. The Power of Zero by David McKnight. When is zero a good number? Zero is a good number when it is your tax bracket. And the book is how to get into the 0% tax bracket by making sure you have no assets that are hostage to the IRS in retirement. All your assets will be tax-free. In some cases, this can make your Social Security income also tax-free. And I've seen it in practice. I have clients that are in the 0% tax bracket due to some of the tax strategies we've implemented over the 3 or 4 or 5 years prior to them getting in the zero bracket. Another great source, I tell everybody I can about this, dinkytown.net, dinkytown.net. I'm going to say again, .net, not .com, .net, dinkytown.net. Any financial calculator you want on that. Mortgages, home equity lines of credit, car loans, and then my favorite is what they call a debt snowball or roll-up. And literally you plug in 3 or 4 different kinds of debt you have, the interest payments, the monthly payments, and how much extra you have, and it will literally tell you how to allocate those payments to where you can accelerate that payoff schedule. Generally speaking, I see that results are 50% of the interest is saved. You pay off debt twice as fast. Sometimes it goes down to a third. So great source is dinkytown.net for financial calculators. Real briefly here's our sources of where we obtain data and some websites that you can go to learn more about some of the topics we covered. The final slide we have is our name, and our email is info, I-N-F-O, at GuideSpringWealth.com, or our website, GuideSpringWealth.com, or you can reach us at 970-818-5243. I'd certainly love to hear your comments and your feedback on whether you enjoyed this presentation and thought it was helpful. If there's anything I can do for you in the future, don't hesitate to ask. Have a good day.